Hello and welcome to Business Incorporated live on Channels Television. It's a brand new trading month. Not looking good for some asset classes right now, even safety. Here are the stories you should be looking at. Kenya has trimmed its repayments to China by more than a third, converting dollar loans for a major railway project in yuan. The U.S. and African Union have launched a strategic investment working group, shifting from aid to long-term investment-led partnerships. And gold's wild price swings have surpassed Bitcoin, with 30-day volatility hitting 44% highest since 2008 financial crisis. And it's great to have you join us. Let's get a quick check on what's playing out with commodities that we track now. And yeah, we're seeing some bleeding right there in the market. We're seeing oil prices. It fell sharply. I will see, that's natural gas. Yeah, that fell sharply today. About $3.59, 17.55% down for natural gas. Now we see Brent crude holding on, $66.19 a barrel. WTI, $62.03. They're holding on. Prices are moving as President Donald Trump said Iran was seriously talking with Washington, easing fears of a supply disruption. Both benchmarks surged in January, with Brent up about 16%, WTI rising 13%, marking their biggest monthly gain since 2022. And yeah, talking about bleeding, we're seeing gold and silver. The prices fell today as increased CME margin requirements added to selling pressure following Kevin Warsh's nomination as the incoming Federal Reserve Chair. Spot gold, we see that drop about 0.87% to $4,672, recovering from nearly 10% intraday slide, while silver rebounded 2.56% to $80.47 after plunging about 15%. Platinum palladium also retreated, highlighting ongoing volatility in precious metals markets there. And yeah, let's track some of this volatility now to help us get some technical knowledge on what's playing out there. We have Sunil Dixit, is an analyst with SK Charting. Great to have you, Sunil. Yeah, so Sunil, we're seeing big price swings so far from the last trading day in January, and it's starting off the same way in February. But talk to me about support levels traders should look out for when it comes to gold and silver.
See, the sharp decline from historical highs of 5,600 was quite obvious, and it came a bit early. Because the sharp decline was expected actually in the following month, that is February, but it came a day earlier. From 55.98, it has fallen directly to 4,400. That's the huge fall of $1,200 also. And currently, 4,800 and 4,850 seems to be a critical immediate resistance, which both need to reclaim in order to extend the recovery further towards 49.50. And on the downside, 4,400 remains vulnerable as 42.50 awaits below that. And short-term swings, short-term recoveries apart, but the down path is still intact until 49.50 and 5,000 psychological zone is reclaimed in gold.
All right, so I guess investors should be watching out for $49.50 to $5,000 for gold. If those levels are reclaimed, then I guess we'll see an upswing with gold. Exactly. But from what you're seeing right now, what do you think is the right trade at this moment? Is it to go short, or are you going to try and take a risk to go long?
I think the downward pressure will remain in short term, at least for a couple of days. Until 5,000 zone is not reclaimed, short-term pressure will remain.
All right, definitely. We like to, see all those levels when it comes to support and resistance and levels to reclaim with gold. So there we have it. If $4,950, $5,000 is reclaimed, then we'll see if gold can make another return. Thank you so much, Sunil Dixit.
Okay, thanks.
All right, so see, Lagos is hosting Investopia Global Africa for the first time on the continent, bringing together business leaders, investors, and policymakers from around the world. At the forum, Nigeria's Minister of Industry, Trade and Investment, Dr. Jumoke Oduwole, reassured investors that UAE capital is safe in Nigeria, highlighting opportunities across infrastructure, agribusiness, technology, AI, data centers, and financial services. Meanwhile, UAE Minister of Investment Mohammed bin Hassan Al Suwaidi emphasized deepening private sector collaboration and building a utopia for investors. The highlights of the event was a landmark MOU between First EMP and Digital Energy, paving the way for AI-driven energy solutions in Nigeria. And to some other African stories now, we see ShopRite Holdings expects profit for the second half of last year to rise by up to 10.2%, lifted by a strong festive season demand. The country's biggest grocer said in a preliminary estimate today. The retailer sees her headline earnings per share from continuing operations rising by 5.2% to 10.2% in the 6 month ended on December 28, 2025. From a restated 659.8 cents. And Strategic Investment Working Group, the United States and the African Union have taken a decisive step towards reshaping Africa-US economic engagement with the launch of a Strategic Infrastructure and Investment Working Group, signaling a shift from an aid-driven cooperation to long-term investment-led partnership. And sentiment among South African manufacturers climbed to a 3-month high in January, driven by improving local demand. Absa Group's Limited's Purchasing Managers Index, compiled by the Bureau of Economic Research, rose to 48.7 points from 40.5 points in December. That's according to the Johannesburg-based lender in an emailed statement today. And Kenya's debt repayments to China fell by more than a third after the conversion of dollar loans for a railway project into yuan, offering reprieve for the economy struggling with mounting liabilities. The East African nation paid 37.5 billion shillings to the Export-Import Bank of China for a semi-annual installment due in January. According to the controller of budget, Margaret Congo, that compares with about 59 billion yuan it paid in the same period last year. And in Nigeria, the Rivers State government has reiterated its commitment to creating a stable and investor-friendly environment to stimulate economic growth, job creation, and sustainable development across the state. This assurance is given by Governor Sunlai Fubara, who was represented by the Deputy Governor, Professor Ngozi Odu, at the Rivers Entrepreneurs and Investors Forum's Business and Investment Summit held in Port Harcourt. President of the Rivers Entrepreneurs and Investors Forum, Ebefere Bob Manuel, notes that Rivers State's economy remains fragile when federal allocations are excluded despite its abundant resources and strategic importance. Take a listen.
30 years ago, if you press your Google and you Google, 30 years ago, the economy of Lagos State was about the same size with the economy of River State. 30 years ago. Today, Lagos is the 5th largest economy in Africa. I mean, I want you to wrap your heads around it. Today, where is the economy of River State? The economy of River State is nowhere in the equation. We feel we do well because of the amount of money we get from the federal allocation. But take away the federal allocation, you find out that we're doing very little or nothing. Considering where we came from, where Lagos is today, and where we are today. You have the RRDL, an investment of $3 billion that SPV signed a partnership agreement with one of the IOCs in River State in Nigeria, one of the major ones in Nigeria. They signed this agreement, and that project had been on the pipeline for 10 years. They're basically going around shopping, looking for suitors, willing investors to come and invest in this project. As we speak, I'll give you the good news that investor had been identified in China, and they're very willing to spend that $3 billion in real estate to develop a dry deep port and a dry dock. Now, the point we are is at the point where the state, which ordinarily should be the simplest of all of these dynamics, the state should be the simplest of all of these dynamics, because what the state simply needs to do is to provide that enabling environment for such major investments to come into the state. But at the same time, today is discordant tunes that we're getting from the private sector, and it's not good for our business.
Yeah, that's the president of REIF, that's B3 Bob Manuel. All right, to our next conversation, we'll dive into some key dynamics shaping Nigeria's investment landscape. Despite the booming stock market, mutual fund assets remain almost entirely in money market and fixed income instruments, raising questions about cultural and economic risk aversion. And this is data coming from Chapel Hill Denham. Joining me now to unpack this, we have a favor. Talk about this, a portfolio manager at Chapel Hill Denham. Great to have you on the show.
Yeah, thank you. Thank you.
Right. So according to your recent data now, Nigerian mutual fund assets are about 99% concentrated in money market and fixed income products. What cultural or economic factors might be driving this extreme, risk aversion compared to the 40 to 60% equity allocation seen in developed markets?
Yeah, thank you. So I'm going to be looking at this from three major points. If the first of which is when you look at the Nigerian macroeconomic space, you would see that we've been having a double-digit inflation figures, right? Let's say between 2020 and 2024, averaging about 18 to 20%, right? In fact, as of the end of 2024, inflation figure was around 34.8%. When you have such an inflationary pressured environment, what you would typically see investors do is that investors would seek to preserve their capital, right, and chase liquidity rather than putting their funds into an instrument that would deliver long-term return. The second point is when you look at the current interest rate environment, you would realize that there's been some sort of distortion, right, as we've had elevated macro MPR, right, over the last 5 years. So if you look at it, the MPR currently stands at 27.5%. That is somewhat elevated, right? And the environment has created some sort of performance, right, for the money market and fixed income market, right, which has given a little bit of comfort to Nigerian investors who would rather position their funds where there is safety, right, rather than looking for real return. So that's basically what we'll see. If you then look at this compared to what you would typically see in developed markets, where bond yields are usually around 2 to 5%, compared to what we have in our fixed income and money market, where you would see yields sub-20 levels and then high 20% levels. That is very, 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 very sort of encouraging for Nigerian investors when you look at it from a relative standpoint compared to what we have, in the US or developed market, where investors are sort of forced or put under pressure to look for real return in another market, which most of the times you would get in the equities market. I would also like to quickly touch base on the fact that the 2008 and 2009 crash, which sort of affected the equities market, is also sort of giving a traumatic experience for investors, right? The crash wasn't even the issue. It took the market about a decade to recover. And this recovery is a little bit slow compared to the recovery you would see in developed markets. So this also sort of shaped how investors behave in the Nigerian market and their dispositions towards equity. So the last thing I would say to answer this is the market demographics, right? If you look at it today, just like I said, the assets under management in the mutual fund is about 7 trillion when you remove AUMs in the alternative, and just 1% of that 7 trillion is actually invested in equity mutual funds. That says a lot. And the major thing is that I realized that 70% of those investors, right, are actually retail based. Right, they are retail investors, which means that Nigerian market is highly concentrated with retail investors compared to what we see in developed markets, where we have pension assets, insurance assets, dominating, the mutual fund space, and in such they are able to confidently, put in about 40 to 60% because those investors, those corporate investors, are long-term players, unlike what we see in the Nigerian market, where we have more retail. About 70% of the entire bucket of investors are retail guys.
All right. So, yeah, thank you for helping us paint that picture. But very quickly now, I would say the Paramount Fund reported a 12-month return of about 80.83%, significantly outperforming the NGX return of 57.68%. What specific elements of the fund's, free float weighted index approach likely contributed to this 23.15% alpha?
Yeah, thank you so much. So what I would just quickly say here is that from our strategy, it is free float index based, right, compared to the ASI that is market cap based. So two things, assets, allocation effect and selection effect. So what we've done in the Paramount Fund over the last 12 years is that we add liquidity adjusted selections, right? Which meant that the stocks that we invested in are stocks that have very high liquidity and stocks that have large capitalization, which means that we are not just going to focus on stocks that have large cap, but stocks that have high liquidity also. So our strategy is free float driven, hence the need for us to invest in stocks that have high liquidity. So what I'm going to say here is this: if you look at the bucket of, if you look at the entire market, you would realize that most of the big names, most of the large cap stocks are not very, very liquid, right? So the Paramount Fund focuses on stocks that are big, but also very liquid. And that has helped us in three things. Number one, you would realize that PFAs, or large corporate investors, most times focus on liquid stocks.
Right.
And that is where the Paramount Fund has positioned itself, such that when there is an increased level of activity, the Paramount Fund is able to benefit in that regard. Number two, the Paramount Fund was also able to rebalance quickly based on our strategy, because we have highly liquid stocks, which means that in the last 12 months, we were able to take advantage of market dynamics, market opportunity, compared to stocks that be illiquid, right? Which also means that when you come into the Paramount Fund, for example, what you would see is that there's even a possibility of having a 24-hour exit or entry, right? Because of how highly liquid, the fund is.
All right, very interesting, because we've had stories, where investors, they buy a stock, and because there's no liquidity, and the free float is not as free as they wanted, they're not able to exit, that asset as they want. But, definitely we'll keep tracking how that plays out. Thank you so much. Favor Teogbade is a portfolio manager, Chapel Hill Denham. Thank you for coming on the show today.
All right, thank you.
All right, let's get a quick check on what's playing out with the markets now. The African continent, we're seeing the NGX there about 8 basis points up there, but the big sell-off we're seeing for the Johannesburg Stock Exchange, 2.28%, a big drop there, 117,000, losing the 120,000 level, and definitely that's linked to most of the mining stocks there listed on the Johannesburg Stock Exchange. We're seeing the big sell-offs with metals, and that's impacting this exchange. Let's get a check on other parts of that market now. EGX 30, 0.84% down, 47,232 points. And we see the Nairobi Stock Exchange closing in the red, 0.34%. That was on Friday, 195 points. Let's get a check on the Gulf region now. We see the Gulf stock markets are trading mostly higher, with the Dubai index leading gains, almost 2% gain there last time we took the numbers. Abu Dhabi index, 0.45%, 10,328 points. All the markets there, we're seeing a big move there for the Saudi Arabia, the Tadawul, 0.87% up in the Qatari Stock Exchange, 0.57% up. Flip over to the US now, and the stock futures, they're down as Wall Street begins a new month of trading, with traders keeping an eye on Bitcoin after a weekend sell-off. Then, as we see, it's all red right there with a big drop for the NASDAQ, 1.01%. Some earnings story there. Disney beats expectations, both revenue and earnings, when it reported its earnings today. The experiences division, which includes Disney's theme parks, resorts, cruises, that crossed $10 billion in quarterly revenue for the first time. And, we're seeing the Dow Jones Industrial Average there, still down, even though we see that the good earnings there. But let's see how that plays out when the markets open in the U.S. Then for Asia markets, South Korean benchmarks tumbled, leading wider declines in the region as investors, they're assessing private data for China's factory activity in January, while, gold is extending losses from Friday. So we see it's red on the screen. Big drops. Kospi, a big 5.26% drop there. Hang Seng Index, 2.23%. Let's get a check now on the Nifty 50. That's the only gainer there. Big 1.06% advance to close. And the Shanghai Composite, big 2.48% decline. Let's see if it's the same picture in Europe now. Let's turn to Berlin for how European markets are doing. Let's see if it's any better at this point. Chiponda Chimbelu joins me now. Great to have you, Chip. So how have European shares opened the week?
Well, Ladi, European stocks are also gaining now, and they are up around 0.5%, but they did struggle lower. They were lower earlier today. They were struggling in the earlier session, and that's because of that global rout you mentioned there in energy and metal shares. And that comes, of course, after U.S. President Trump's nomination of Kevin Warsh as the next U.S. Fed chair. And there are fears, Ladi, that the U.S. Central Bank could lose some of its independence, and that's why gold, silver, and industrial metals have continued to deepen their losses after Friday's session. And the sell-off in energy shares has, of course, been sparked by the signs of geopolitical tensions between the U.S. and Iran easing. And so European energy stocks are also down, and they were down 2% in early trading, Ladi.
And now to another story. Germany's unemployment rate climbed to its highest level in 12 years. Last month, it's another sign that Europe's largest economy is still facing, significant challenges.
Yes, it is. The latest figures actually show that Germany's unemployment rose to 6.6% last month. And Ladi, perhaps the more interesting number is that there are now more than 3 million people here in Germany who are out of work. Now, the unemployment rate is actually at the highest level in a dozen years. And according to the Labor Office, Germany's job market has very little momentum. And to be quite honest, that's not so unusual at this time of the year. Unemployment usually rises in January because many fixed-term employment contracts expire at the end of the year. And there are also industries such as construction, agriculture, and tourism which reduce their workforces because they rely on weather for their business. And many companies, of course, also put off hiring new employees at the end of the year. But the latest figures, Ladi, are still cause for concern. And the consensus among experts here in Germany is that the government has done little to jumpstart the country's struggling economy. And the government's large fiscal package hasn't had much of a positive effect as had been expected when it was announced last year.
So what are the latest figures?
Well, I mean, economists, the latest figures are basically that we won't be getting as much growth as expected next year. And in the coming months will be quite decisive, Ladi. And that's because we will get to see whether the German Chancellor's plans to jumpstart the economy are really having their intended effect. This is actually the first year that the massive stimulus for infrastructure and defense begins flowing into the economy. And Germany, on top of that, will also have 4 regional elections where we will really get to see how the country's ongoing economic struggles are affecting ordinary people, because we will get to see how they vote. Now, how the parties in the ruling coalition perform at the polls will be a verdict of what Germans make of their government's economic plans. And while the country is not in recession as it had been, and the economy is finally expanding, albeit very not so significantly, very small expansion there. But that is, of course, something that ordinary Germans are not focusing on. They are looking at whether they have enough money in their pockets. And so we really do need to keep our eyes on those unemployment figures in the next months, because they really will be an indicator of how Germans feel, too, about how their economy is performing.
All right, thank you so much, Chipando Chimbelo, and happy new month. Thank you.
Thank you.
I just got a quick check on what's playing on the crypto market there. We're still seeing it's red on the screen there with Ethereum, $2,300. Bitcoin, that's down 1.01%, $77,000. So I guess investors just wondering where is the support at this point with this sell-offs. Top stories: Chainlink dropped and held ground below $10, touching a low of $8.09 for the first time since September 2024. Chainlink is that a middleman that connects other, blockchains. Then other stories right there in the market. We're seeing Binance. They moved a couple of Bitcoins into their Safu wallet. Another word for safe. About $100 million in Bitcoin sent to that wallet. That's 1,315. Transpired in one transaction. Then we see corporate FL holdings are taking a hit after the latest market correction there. Bitmine, there's about $7 billion in paper loss. And definitely when you see big sell-offs like this, it does affect other investors and, big investors at this time. So that's how major markets we track are looking today. The sell-offs continue. We'll see if there's some kind of reprieve maybe later today or tomorrow. But thank you for watching. I'm Ladi Williams. Bye for now.